Hello and welcome to today's webinar. I'm Cherry Reynard, and with me today is David Baker, a partner at Baker Steel and manager of the Baker Steel Gold Precious Metals Fund. We're going to be talking a little about the recent gold run, but also about opportunities in silver and other precious metals. So welcome, David. Thanks so much for joining us today.
News.
Now, since we last spoke, the gold price has soared to new highs, so it's taken a bit of a pause over the last week or so. Um, let's talk a little bit about what's driving the price at the moment. Is it mostly a sort of Trump effect and a response to macroeconomic uncertainty?
I think it's a number of things. I think the geopolitical issues, the fact that the market's getting worried about the debt levels in the US, and the US has got to refinance a lot of debt coming up, and I think that with the tariffs, people are just a bit wary. They're seeing what Trump's doing. He's using this kind of chaos theory, and bringing tariffs in and then being a bit random and stuff. And a lot of the governments of the world are looking at this and thinking, actually, do I really want so many US dollars? Do I really want to leave all my reserves in US dollars? And so there's a shift into gold, and you can see that because the central banks are continuing buying. They're buying about 1,000 tons a year, and that's fairly consistent. You're starting to hear rumors of more governments or more countries settling trade with gold instead of dollars, and there's all types of new infrastructure that's going to be built or being built for that, particularly for the BRIC economies. So I think also, we know that the US, Trump and Bessent, want to lower US dollar, and that's generally going to be good for gold and other commodities as well. So I think there's plenty of reasons to be optimistic on gold, but we've run hard, and normally when the market runs hard, you've got to have some kind of consolidation. You've got to shake the tree a bit and basically, get rid of some of the loose holders, if that makes sense, and it's got to test you. You've got to think, oh, why did I buy that? And that type of thing. So, gold's at what, 26% so far this year. The gold shares are up about 42%. So I think we're going to have a bit of a consolidation. That's how we've structured our portfolio. We've taken some profits from, some of the really strong performers. But having said that, I think the long-term outlook for gold is fantastic. I think that, central banks are going to carry on growing. You've got to remember in the 1970s, gold was 45% of central bank reserves. Now it's 22. So there's still a long way to go. And I kind of think, there's been talk about the gold revaluation. I think we might have mentioned that in the last podcast of the US, because, a lot of the central banks in the world hold gold. And one way to restore their balance sheets, and because they've been building up all these liabilities instead of defaulting on their bonds, is to increase the asset side of their balance sheets. And they all own gold. So, the argument is that they revalue gold, and that helps basically balance some of the balance sheet going forward.
Okay, great, thanks. And you mentioned gold equities there, and we talked last time about the relationship between gold price movements and gold equities. And at the time, it was that gold equities had not kept pace with the soaring gold price. I mean, it sounds like that's recalibrated a little. Can you sort of unpack that a little more?
Yeah, I think that there's a reluctance, if you look at the number of shares on issue in GDX, which is GDX is a ETF of all the mining companies, and it's been falling. So despite the gold shares going up, the money flowing into these ETFs is falling. And so I think there's a bit of skepticism by some players that they think the mining companies are going to perform. But we've just started the reporting season on the gold side, and I'd have to say that it's very positive, that the results have been good. The mining companies are buying back more shares, and they're paying good dividends, and They're not looking at squandering their money and building new projects. Like that's effectively that's what they did between 2000 and 2011. They squandered a lot of this excess cash and basically tried to grow. Now it's more about returning cash to shareholders. And I kind of think that the amount of cash that's going to, I don't think we're going to see massive increases in the dividends. I think it's going to be more companies are going to just increase their share buybacks. So I think the results we're seeing, and particularly some of the second liners as well, or the mid caps, they're starting to generate some good cash. And, we've seen a bit of M&A, which is encouraging. We've seen a few mergers of equals, which is good. So companies not paying massive premiums to the other party. And I think there's a feeling we're going to see more consolidation. So yeah, I think it bodes well. So although we're seeing this correction in the gold price, it's inevitable we'll see some weakness in the gold equities, but I'm not convinced we're going to, does it correct by 10% or 15%? But I don't see a 35% correction or a 20% correction. So, and when I'm looking at the results, I'm kind of saying, these are good results. The gold price, I think, can probably fall back to 3,000. I don't think it's going to go back to 2,500. I think there are too many positives. So we're going to carry on, we'll have a correction maybe down to 3,100 or 3,000, but the market's not really factoring the current price in any way. The equities aren't factoring the current price. So we will have some correction, but I don't think it's going to be deep correction. And we're looking at that opportunity to basically buy some of these really good mid caps that we're seeing.
Okay, so still factors that could drive stronger performance, or at least a stronger relative performance in gold mining equities.
Yeah, no, I think there's the quality of the assets is good. The companies are generating cash. They're returning a lot of cash to shareholders. The companies that we really want to find is companies that are returning cash to shareholders and at the same time basically being able to fund share buybacks and dividends and then growing their companies as well, and that's the holy grail. So you can get the cash return as well as a bit of growth.
Okay, great. Now, obviously gold that tends to kind of command all the attention. But silver, if anything, could be even more interesting. So let's take a look at the dynamics of the silver market. First, let's talk about the relationship between silver and gold and how they've been correlated historically.
The silver market is just so complicated at the moment because, that you can basically buy 100 ounces of silver with 1 ounce of gold. And it's very rare that you see the gold silver ratio over 100. To give you an example, in 2011, the gold silver ratio was 30. So it's gone from 30 to 100. And any time it's been over 100, typically 6 months later, silver's outperformed, and done rather well. The confusion that you've got in the market is how deep the recession's going to be and how deep the slowdown is with the tariffs. And, I think it's going to resolve, but there's still question marks over that. And silver is certainly more an industrial focus. If you look at silver demand or silver demand, it's covered by about, the biggest slice of silver demand is industrial demand, and that's probably in the region of, upwards of 70% of demand. But what is interesting is that silver demand has been growing. So if you look over the last 10 years, the industrial demand for silver has grown by around 60%. And it just carries on growing. Silver, in my view, is very cheap. And so goes in a lot of electronics, it goes in solar panels, it goes in lots of things. And if you look at the silver price, And actually, if you look at the supply demand fundamentals for silver, we've been in a deficit since around 2000. And that deficit's been around anything from 15 to 20%. And it just doesn't look as though that deficit is going to get resolved in the near term. I was reading a report this today that one broker put out, and they can see 20% deficits till the end of the year. The demand, we're not seeing any growth in mine supply. There's just no growth in mine supply. It's not coming. And when I speak to the mining companies, one company the other day had done an acquisition, and I said, "Oh, why did you buy that?" He said, "David, we looked everywhere and we just couldn't find a, a, a better asset, and this is a small asset, equivalent of around 60,000 ounces of gold production. So these are small assets and there just ain't any around. So our view is that the demand is going to carry on growing. We might have a bit of a hiccup this year, but most of the demand is in things where there's still a lot of growth, whether that's solar, the green economy, data centers, electronics, EV cars, all that type of thing. So I don't think that silver demand or silver demand on industrial demand is going to collapse. It didn't in 2020, but at the margin, you might see a bit of weakness and the market will play that weakness. But anytime you see that gold silver ratio over 100, I'd argue that silver is an interesting play. And if you look at the silver equities versus the gold equities, they're tracking that gold silver ratio. So they've been fairly poor performers so far this year as well. And
Yeah, and just before we come on to looking at those industrial drivers in a bit more detail, I'm just wondering what the kind of balance is, because presumably silver has a role as a financial asset as well. So is it possible to say how much is kind of industrial demand and how much is its role as a sort of financial asset, and to what extent each drives the price?
well, I think that, what you've seen is a big growth in the ETF physical demand for gold. You've seen some growth in the ETFs for silver, but by no means as much as you're seeing on the ETFs on gold. Now, if you start to see increases in that demand for silver on the ETFs, and what could drive that? Lower interest rates, QE, people basically deciding, well, I think I've missed the gold market. Should I buy silver just in case? I don't really want to pay up for gold, but if I buy silver, I think I'm going to do relatively well on that. So we're watching those ETF flows, and at the moment, we're seeing some increase, but not as much increase as we're seeing in the gold side. But remember, the gold price is $3,300 an ounce. So you need a lot of demand to absorb, that gold at 3,300. It's not going to take much of a flick in demand for the silver ETFs to really have an impact. And we know the market's tight, the supply demand fundamentals are interesting. The market's been in a deficit for 5 years. As I said, the last couple of years, it's been around 150 million ounces, and the silver price has increased by about $10 an ounce over that period without any ETF flows or anything. So I kind of think you're underpinned at that $30 an ounce, maybe. And if we carry on to seeing some growth, we're going to carry on seeing more that industrial demand just basically eat into inventories, and the price is going to carry on rising. So I wouldn't give up on silver. And like I say, at 100 to 1, I think that's the bet I'd probably be taking. It's a bet we've taken with, in our fund. That's probably caused a bit of our underperformance, but we've not done too bad at all despite having that, and we've still got all that optionality on the silver to come. But there's just not many silver producers that you can buy. We don't want to go into the rats and mice. We think that they're too small, and you know, the main silver producers, a lot of them, the gold and their byproducts pay for all their costs. So effectively, you get all the silver for free. So, you know, and they're, you know, the problem is with silver, we've been through such a long bear market that the companies haven't really yet resolved all their balance sheet items, but they're starting to get there. The cash is starting to flow, and they're starting to make some good money with this gold price and this silver price. So we think they're an interesting option. You know, they're not going to go bust, and if the silver price goes up, I think that there'll be a switch back into these companies.
Okay, cool. And you mentioned some of the industrial uses there, and they all seem like high growth industries. So electric vehicles, solar panels, AI hardware. I mean, are there any others, any areas I'm missing there?
Jewelry demand's a big part. AI, like you said, you know, for the data centers, solar's the big one. You
Mm.
know, solar's probably about 35% of um, industrial demand. But the growth in solar has just been phenomenal. And I think that, you know, there's been thrifting in silver, you know, so the amount of silver that's used in solar panels has fallen quite dramatically. But the growth in solar installations has outpaced the weakness in the thrifting. So you're still seeing growth. You know, I think it's probably in the region of 10 to 15% this year, up to around that 235 million ounces of silver. And the outlook going forward is that, you know, the constraint on growing or installing solar is more on the grid than actually putting the solar in. So, but that will resolve itself. So we're quite optimistic, and particularly places like India and those places, there's very, very strong demand. So it's fascinating that basically silver's so cheap that they're putting 235 million ounces a year into solar panels that basically they won't be able to get back for 25 years. You know, they're locked up for 25 plus years. So it's the equivalent of the central bank of, you know, gold demand by the central banks is around that 25, 35%, and solar is similar
Yeah.
for the solar industry. Silver's for the solar industry.
And you mentioned the silver companies there. I mean, do you expect that the same relationship between the silver companies and the silver price as you do between the gold companies and the gold price, where in normal circumstances, silver companies would kind of be a leverage play on the silver price?
Yeah, I think so. If you look, like I say, if you look at the performance of the collective of the silver shares versus the gold shares, the silver shares have underperformed. You know, the gold. If you look at the gold silver ratio, you know, the market's playing that through the silver shares. So does that rotate if that gold silver ratio comes down? I think it will. But it's teasing us, you know, it hasn't come down yet. And that's the uncertainty in the market. But I think that it will. But having said that, also, I think the point is that the main silver producers are not in dire straits. You know, they're generating good cash flows. They're on free cash flow yields of anything from 10 to 15% at today's metal prices. And, you know, because most of them have to produce gold as well. You know, silver's, you know, they're gold producers with silver. Um, you know, Fresnillo's been a real win. You know, that's just been fantastic. That's nearly doubled. And um, and it's paying a healthy dividend. The other ones aren't quite to that stage yet, but I think that's coming.
Okay, great. Now let's just spend the last 5 minutes looking um, in a bit more depth about how precious metals can be used in a portfolio. So I just wonder if I could get your view on how investors should think about sort of balancing exposure to gold and silver and precious metal miners in a portfolio.
Well, I think that, you know, everyone's played the 60/40 portfolio before, you know, it's been the bonds and the equities 60-40. Now I think it's clear that instead of that, you've got to add a bit of gold as well. And whether that's 10% or 20% is up to the individual. You know, arguably you want some physical gold, but the equities are now, I think, going to start outperforming the physical gold. So I think if you get into that, you know, the gold equities have underperformed physical gold over the last 10 years, but I think now we're starting to see signs that they can start to outperform. So I'd certainly put some gold equities. The gold equity market is a very small market. You know, it's probably 600, $800 billion, which is minute in the size of the financial world. So if people start allocating, and I'd argue that they haven't been allocating at the moment, then I think that, you know, it's going to do well. But you know, the key is that the companies are behaving, you know, they're returning capital, they're being disciplined, and that will gain more of the generalist interests and investor interests. So, you know, I certainly think there's a role for gold and gold equities. We've seen it because of the negative correlation between the S&P and gold. I just think personally that you know, that relationship has moved very quickly. You know, gold has outperformed the S&P very dramatically this year. I think you need a bit of a breather before it carries on, personally. I might be wrong on that, but I just think that's, you know, so I'd be looking at opportunities to accumulate in any weakness.
Okay, great. And let's just wrap up with a quick sort of update on the fund. Just talk a little bit about how you're balancing exposure to the various metals in the Baker Steel Gold and Precious Metals Fund at the moment.
Yeah, I think we're about 67, nearly 70% in gold. We're just under 20% in silver, and we've got a few of the PGMs, the platinum group metals. And, you know, that's an interesting market in itself, you know, because the platinum market's very tight. You know, mining companies have been losing money in that, you know, they've been closing mines. So we think that you know, the outlook for the PGMs isn't too bad either, you know, but again, you've got to caveat that with how much of a slowdown we have and the tariffs. But I kind of think that the tariffs are going to get resolved. I mean, but we're just playing this brinkmanship at the moment between the US and China, you know, and that's, you know, the nervous thing. But I kind of think that's going to get resolved at some point. I mean, if it doesn't, you know, batten down the hatches, because I think it's going to be very tough. And I just don't think that Trump is going to take us to the wire, but you never know.
Yes, let's hope not. There's been slightly more encouraging news in recent days, so let's hope that continues. Okay, David, thank you. That's great. We'll wrap up there. Thank you so much for your time today. And as always, thank you to our listeners for tuning in. So until next time.
That's my pleasure. Thank you very much.